Okay, good morning guys. Welcome to the brief of the 30th of June 2017. It's been a busy week and a great Friday to be delivering the brief. Yesterday we saw what was amongst one of the most volatile days of the year so far, which was particularly interesting given the fact that we have had relative low volatility in the markets for at least the first half, with sporadic bouts here and there, obviously with the UK referendum, so on and so forth. But today was, well, yesterday was a great session in the way that there were some big defined moves, and if you could get your head around what was going on, and that's what I'll be discussing today, there were some opportunities in the mix. So today I'm going to start with going over, well, initially we're going to go over BOE, ECB, followed shortly by oil and commodities as a whole, and then we'll look at the day ahead. So we start off by looking at the chart so far. It's been a quiet morning so far. The first thing I wanted to look at coming in today was the Bund, particularly because if we have a look at the chart, this has been one of the biggest movers in the market thus far. So I wanted to see what the sort of sentiment for today was. Really not doing too much. It's been a, well, it's exactly where we opened today, so nothing of particular note there. Having gone through the European cash open as well, the DAX still a little bit on the back foot, but given the fact that we're not seeing a sell-off in the Bund at the moment, I'd be sort of hesitant to get involved here. So it's been a relatively quiet morning, which is to be expected. This is common to see in the marketplace, especially after a very volatile day, as we saw yesterday. That being said, having a look at the euro this morning, that has just broken through the pivot and is now looking to go test the S1 level. I wouldn't be looking to read too much into this. If we look at the euro as a whole, since the 27th being the Tuesday session, we've rallied quite aggressively. It's just a bit of profit taking over here. I don't want to read too much into this. We're up from the lows to the highs, up 2.2%. Technically speaking, S1 doesn't look like a bad place for support. It defines the top end of the price action. We saw on the 28th there was a bit of support in the morning as well yesterday. This little spike low, I believe, was the Weidmann's comment about broad base accommodation still being necessary and appropriate. This is quite surprising coming from a German central banker, particularly because, as we know, Germany tends to be on the hawkish side, given the fact that their economy has been doing pretty well. So apart from the euro move so far, not much going on in the markets. Let's have a quick cable's basically flat, still at its elevated levels over here. So let's talk a little bit about the journey sterling has been on. So what's been happening with sterling so far? Well, we've been quite familiar with the situation in the UK than the Bank of England, particularly because what we've been seeing is inflation rising due to the sudden fall in sterling and the continued fall in sterling. We're still at very depressed levels following the leave vote, and this spike lower in sterling is ultimately what resulted in inflation creeping up near enough 3% at the moment. But following on from this, what could a central bank have done to sort of curb this inflationary pressure here? They would have generally liked to have appreciated the value of the sterling, therefore bringing down inflation as a whole. But given the economic and political uncertainty faced in the UK on the back of and the Brexit negotiations were still taking place, and of course we had David Cameron stepping down, Theresa May taking over, then the snap election, then the hung parliament situation. I think the Bank of England has been very smart so far as to not go ahead and raise rates, ultimately, which would have squeezed the credit facilities available to the general public as a whole. But this has meant that inflation has continued to creep higher and higher and higher. We've seen a relatively small and modest recovery in sterling if we look at the week before as opposed to what's happened the last few days, but still at very depressed levels. So then the question was, how is the Bank of England going to be curbing these inflationary pressures? And as we know, a central bank has three main tools at their disposal. They've got interest rate rise, asset purchase programs, aka QE, and then third and finally they've got communication. A lot of the times, especially with some of the newer traders, I think they underestimate just how important communication is. And if we see what's happened to sterling for this week as a whole, this rally.
So in 10 minutes, looking out for a German unemployment data. The unemployment change expected
of near enough 2% has basically been on the back of communication. This has been communication from Mark Carney as well as Haldane. Now, Mark Carney, who was the person just over a week ago, was saying that an interest rate hike is basically not on the table due to anemic wage growth. What he was indicating here is that wages have not kept in line with inflation, and this means that the consumer is therefore getting squeezed. And if we started to raise interest rates and sort of credit facilities became less abundant, or your sort of repayments on any debts would increase as well, then this would further hit the consumer and ultimately cause negative consequences for the economy. That being said, later on in the week, he goes on to turn around and say that some removal of monetary stimulus is likely to be necessary if the trade-off facing the MPC continues to lessen and the policy decision accordingly becomes more conventional. This was taken as quite a hawkish comment, because this is the governor of the Bank of England, who was previously being quite dovish and not willing to commit to any sort of tightening, coming out and saying, well, look, this may be necessary given the fact that the consumer is still suffering and the British public is still suffering with higher inflation, relatively low wage growth. Now, this is the important part. He actually hasn't done anything whatsoever. He hasn't gone ahead and raised rates. He hasn't even committed to raising rates. He hasn't mentioned anything about the asset purchase program, but what he has managed to do is cause sterling to appreciate for 2%. And if we look at it on the day, it's still pretty elevated over here. So the market has bought into the possibility, or the likelihood of them increasing interest rates by the end of this year has increased, therefore effectively increasing sterling, which would have deflationary pressures on the British economy as a whole. So this is, I feel, very smart of him, because if he's successful and sterling continues to appreciate, and I think this is going to be followed on not very aggressively but modestly so by other Bank of England members. We saw this with Haldane also coming in and saying we need to seriously consider raising rates. If this commentary continues, we should see sterling continue to appreciate. And what's interesting here is he may be able to stem inflation without actually having to use the other two tools, which is altering the asset purchase program or raising interest rates. So it's going to be very interesting to see what the inflation readings are for, let's say, particularly the July month. Now, this could be a little too less, a little too late, in the way that a change in the currency is not going to have an immediate impact on inflation. This is something that we know, and this is something we've seen post-Brexit, where sterling depreciated heavily, and it took almost a year, and we're still seeing these effects. So now that he is using this communication tool to start talking up sterling, in what I feel is, and I think Anne agrees with this, we were discussing this earlier, in a hope to sort of stem these inflationary pressures. Well, it's not as if sterling is going to increase by 2, maybe 3, 4%, and then what we're going to see is inflation take a dramatic U-turn in the next coming month. This may take 3 to 4 months, even up to 6 months, to start filtering through into the economy. So the reading for July will be interesting. I think if we see inflation remain where it is as opposed to continue to increase, I think this will be taken as hugely positive by the market as a whole. But if inflation continues to creep up, I think he'll have no other choice but to look to increase interest rates. Let's not forget Mark Carney was very well respected for his forward and guidance, so his credibility is very high. So if he doesn't then follow through with increasing interest rates, if inflation continues to creep up by the end of this year, I think he's going to be in a bit of trouble. And let's next move on to the Eurozone. Now, of course, the Eurozone is, the ECB as a whole is going to be quite interesting, because we've seen quite dramatic moves already in bonds and the euro as a whole. And I'm sure more of you were interested in terms of the stage 1, stage 2, and some of the live guys as well, the move in the DAX. So I'll look to explain what was happening here and sort of my interpretation of what's happening with Mario Draghi and the ECB as a whole. So we look at euro. This has been appreciating following Mario Draghi's comments. And ultimately, he wasn't particularly hawkish. He was relatively neutral and optimistic about the Eurozone area. Now, this is something he has shown that he appreciates, that the Eurozone is recovering. Inflation readings were creeping up, but then he was always sort of hesitant to focus too much on inflation because he was always mentioning the transitory effects, given the fact that this was due to oil, so on and so forth. And core inflation was still pretty much stagnant, which I agree with him, and that's what we can see in the readings as well. But now that he's been quite optimistic about the growth in the Eurozone, we've seen quite a big reaction in the euro. We've been sort of soaring higher. We had those commentaries from source comments from the ECB saying that they misinterpreted what he said, but then when he came back onto the ECB forum, he continued with the same rhetoric, so we saw euro fully reverse those moves and continue higher. So why is it that Mario Draghi hasn't really said much apart from be slightly optimistic on the Eurozone recovery as a whole? Have we seen such a big move in the euro? I think this is a lot to do with the timing of these comments, and I think he's a smart man and he knows the effect that what he said was going to have. And what I mean by the timing is that at the moment we've got a £16 billion per month asset purchase program, which is looking to continue until December 2017. So we're just 6 months out. Now the market is obviously very aware of this, but what we've been seeing up until recently is him sort of counteract any optimism in the Eurozone with, I wouldn't say dovishness, but with caution, referring back to oil prices, food prices, and the more volatile aspects of the CPI basket as a whole. But this time, the market is now going to start paying more and more attention to what these ECB members have to say, because we're now looking to see what's going to happen January 2018, whether they're going to continue their asset purchase program as it is at 60 billion and extend it, or what I feel is more likely is they're going to start tapering, and I think the market as a whole believes they're going to start tapering, particularly now as we've seen in the euro. So I think the question is, are they going to taper by 10 or 20 billion? But the market is so incredibly used to central bankers facilitating any sort of risk off we see in the market with further accommodation, but this is unsustainable and this cannot continue going forward. There will be a time where we need to start tapering and becoming a bit more less accommodative as a whole. So the market took this as a sign that yes, we are going to be tapering coming into the end of 2018, and the euro has respectively appreciated on the back of that. This, of course, filtered through into other European products such as the DAX and just get the Bund chart up. The Bund, which has been on a sharp decline now for 4 days straight following the ECB comments, and this is the prices of bonds falling and therefore yields rising in anticipation of higher interest rates to be coming. So with euro appreciating, DAX depreciating, and bond yields rising and price decreasing, this is a standard tighter monetary policy trade. This is something which you should be familiar with. You got your risk environments, your risk on, risk off, and you got your monetary policy environments, tighter monetary policy, looser monetary policy. This has been a relatively clear tighter monetary policy environment as the euro appreciates. This hits European equities in terms of their exports, so on and so forth, and then yields rising in line with future rate hike anticipations. So going into today, I feel like monetary policy is still something to be looking at. We may see a reversal and we may see a move back onto traditional risk on and risk off, but I would like to see the correlation break away before I start to preempt and start to trade risk plays. So keep an eye on the correlations between domestic equity markets and domestic bonds. So make sure you're looking at the Bund and the DAX as an example. If they're moving with relatively high degrees of correlation, then this is still monetary policy environment. If they start to deviate and we start to see, as an example, DAX start to rally, Bund starts to come down, then we're moving more back into a risk-on environment as such, particularly if we see similar moves in gold, so on and so forth. Moving on, let's quickly talk about oil. This has been a very interesting move. Very quietly, but very surely, the oil market has been recovering. And people haven't been paying much attention to it. The reason I think, well, some people may be paying attention to it, we've had an 8% bounce from its lows. The reason I'm a bit hesitant here to sort of start going long in the oil market is simply because we've seen a drop in US production by 1%, and of course this is significant, but we're seeing a drop in US production after weeks and weeks and weeks and weeks of increases. We're seeing US rig counts at all-time highs. So now to ignore those fundamentals and take the long, I think, is still going to be a difficult trade to stomach. We are approaching some interesting levels here. We got the $47 mark, which will most definitely be looking to provide some resistance. But right, we saw the reduction in US shale oil. But if we look at the other stories and some of the headlines, this just reminds us that the overriding picture is still pretty bearish for the oil market. Libya oil output nears 1 billion barrels, highest in 4 years. This is another oversupply in the market, another factor which leads to the oversupply. If anything, I would like to pin this move higher in the oil market on probably short coverings. We had quite a bearish move, all-time high bets on shorts on crude on itself, and then probably a little bit of profit taking, a bit of hesitance to get into the market ahead of the DOE. The DOE comes out, we see that decline of 1%, which is of course bullish on the day. So people would have been taking oil higher or lifting the offer, as it would be called. But now that we're here, maybe some people are now just short covering, taking some of their losses or booking in some profit. But I still feel like when we start approaching this 47 mark, which was key resistance on the upside, I have no doubt that the oil market will continue to sell off. And this is in line with what we've been seeing week after week. With oil prices rising, we'll see US production once again increase. So this 1% drop, I have no doubt whatsoever, is going to be fully recovered, and we're going to continue to increase production going forward. This may not be next week, but it may be in the week after. So I'd be careful if you're taking the long in the oil market. Be pragmatic, make sure you book some profit, de-risk yourself nice and quickly. Another thing, looking at one of these articles, just following on from the commodity complex, iron ore enters bull market as Chinese mills up purchases. So this 20% increase in iron ore has now put us back into bull market, which is quite incredible, because if we remember what was happening with the Aussie dollar, it was on quite a sharp decline as the commodity complex was getting hit. But with these gains in iron ore futures, as well as oil, as well as copper prices, this commodity story is obviously very positive for the Australian economy, which is heavily reliant on iron ores and mining as a whole. So this is a market which I'll definitely be paying attention to, particularly because we've now entered a bull market in the iron ore industry. So people would have read these headlines and they will make that connection that iron ore makes up about 22% of exports from Australia. Following on from the Australian dollar, we did get the Chinese PMI overnight, which came out to be, let me just get the figure for you, it was a beat on expectations. It was about 2 a.m. So Chinese manufacturing PMI 51.7 versus 51. Chinese non-manufacturing PMI 54.9 versus 54.5. So this is obviously very positive readings in expansionary territory, but this is something I discussed a couple of weeks ago. The private PMI readings should be coming out within the week, and I think the market will be paying more attention to that. As we saw a month ago, the private readings were contractory, the first time in 21 months, I believe, while the government sanctioned PMIs were expansionary, and the market gave more priority to the private readings over the government readings. That will obviously filter through and have an effect on the Aussie dollar if we see a reduction in the private readings. Now, just looking at the day ahead, well, let's look at some of these markets technically. I'll still be looking or erring on the side of a long in both our major currency pairs, the euro dollar and cable. I think this will be the play, long euro dollar, long cable for the foreseeable future. The only caveat here is if we start seeing hawkishness come out of the Fed, and that's something which is on the horizon. So until we start seeing that hawkishness come out of the Federal Reserve, let's still be looking for longs. Wait for the pullbacks, don't be too aggressive. We are highly overextended on these moves. We did previously go back to test these highs. It would have taken a very brave person to step in front of this market here. But the S1 not looking too bad, technically not the best, but at least we have a good place for a stop placement. The DAX still looking, I feel, for a short. There was a great technical level which was breached the other day, just yesterday, which was over here. This was of course the high from April this year. We saw quite a sharp turn, and then we went to go breach that level, test it, trend higher. So this is going to be a key level to keep an eye on. If we can sustain ourselves below there and sort of consolidate below there, and then this would be quite a bearish indicator for me. I'm sure that a lot of the market was looking at this price action. It took decisive decision to get below there. Just keep an eye on that. You're just quickly looking at US equities. Look, we saw a sharp decline, what could look like a sharp decline in the S&P 500, but we're just testing our lows here. We're testing our lows after an incredible rally following Trump. Things to keep an eye on here. We have Chicago PMI coming out later, which of course, being soft sentiment data, would have a filter through into the equity space, particularly if it's a low reading. Then looking for some downside in your equities, but this would be your secondary and tertiary trade. I would still say trade your bonds and your currency pairs on the back of tier 1 US data, but if it is a significantly bad reading, then this will definitely open up some room, and if this level does get breached, 2400, then that'll be very significant as a whole. Previously provided resistance very well for about 3 months earlier on in the year, then gone and provided support today. So looking at the day ahead, just make sure you wait for your pullbacks, your best entries, because we still are talking about US equity markets. In recent days, it hasn't been as bullish. Normally you'd see the sell-off in the European session followed by quite an aggressive buying going into the American session, if not the American close. This hasn't been the case. There was one other thing I was reading yesterday. I was reading yesterday on Bloomberg, and that was just going to say that statistically it's been proven that volatility increases in the second quarter of the year. We're now coming up to the end of June, start of July. We have seen a relative increase in our volatility measures. But if we do look at the volatility measure, this was the VIX over here, the white line. We did spike about 50% at one point yesterday, but then we did come back quite sharply later on in the session. So, I remember looking at the VIX at the end of the session yesterday. It was around 10.71, and I was just gobsmacked. I was like, how is it so low given the sort of volatility you've seen, particularly in the European equity markets? Only later did I find out it did spike earlier on in the session. Okay, just looking at the day ahead. So we've already had quite a bit of Japanese data come out. We discussed the Chicago, the manufacturing PMI coming out of China, slightly higher than expected. Of course, this would have generally positive sentiment, positive feed through in sentiment to equity markets, but I think that'll be on the back foot. Most importantly, I'll still be looking at your bond markets and your currency markets to give you a lead indicator as to market sentiment for today. For the rest of the session, we got UK GDP growth rate final. I appreciate this is the final reading, but given where sterling is positioned and how many traders will have this on their primary page, I wouldn't be holding any positions over this data set. I think a lot of times people can become complacent, stage twos, with regards to holding positions over data. But even if it's the final reading, particularly in a currency pair such as cable, I'd definitely be looking to get out there. 10 o'clock, you have your Eurozone CPI readings. It's your final readings for the month of June. Of course, this will be relatively interesting. Given the fact that we've had better than expected readings from both Germany and France, this is looking to be quite a positive number. Following on in the afternoon session, your 1:30 data set, you got personal spending month on month for May. PCE price index. Now the PCE price index is obviously the preferred inflationary measure for the Fed, so I'll be keeping a close eye on that. So the afternoon in itself is quite busy. We have obviously your core PCE. Again, your core PCE, given the volatility we've been seeing in the oil market, is going to be very interesting to see how, if we strip away the volatile components such as food and oil, how the inflationary pressure in America is doing as a whole. And Canadian PPI, if anybody's trading the US CAD. And 2:45, you've got your Chicago PMI. So we've got a busy day ahead. We've got a very, very busy day ahead. We may have some opportunities in sterling coming into 9:30, and that may follow through till about 10:30. But then again, guys, remember 10:30 till 11, 12 o'clock before we get the North American crossover. Stay out, most likely. Stay out of the markets. We have more than enough opportunities coming into the afternoon. We have inflation readings, which is obviously on the tip of everyone's tongue. And then we have your Chicago PMI, and then we got revisions to your Chicago, your US Michigan sentiment as well. So there's going to be two key readings into this afternoon. So when you're looking for your long euro and cable, maybe you can execute these early on in the morning. But coming into the afternoon session, I'd most definitely be waiting for the US data to come out. Nobody's going to be going long euro and cable when we have such important data sets coming out of the United States. Okay guys, best of luck. Please feel free to drop any questions. I'll be in trading room. And thank you very much.